Hello, my name is Akbar Safdari, and I am an AML and compliance instructor. Welcome to the North America AML and Compliance Academy, also known as NAACA. On this channel, I provide clear and practical training on anti-money laundering, KYC, counter-terrorist financing, compliance regulations, and financial crime prevention, designed for professionals working in banking, financial institutions, fintech, and regulated businesses. If you would like to enroll in our courses and receive an official training certificate, please visit our website, www.naacacademy.ca. Thank you for learning with us.
All right, let's get right into it. We're going to break down a financial scandal that sent absolute shockwaves from Singapore all the way across the globe. So let's kick things off with the number that blew this whole thing wide open, over $3 billion. That's how much was allegedly laundered in what's supposed to be one of the most trusted financial hubs on the planet. You see, this is the story of that scandal, the fallout, and more importantly, the critical lessons that every single financial institution out there now needs to learn. Okay, first up, the scandal itself. Let's get into the weeds of what actually happened here because this really started to unravel back in 2023. So who was involved here? Well, you've got this whole network of foreign nationals working with multiple financial institutions. And the regulator caught in the middle? That's the Monetary Authority of Singapore, better known as MAS. And this whole multi-billion-dollar scheme was happening right in their backyard, in Singapore, before it all came to light in 2023. It was a huge blow to a place known for its squeaky clean reputation. So how'd they do it? Well, it was a pretty classic playbook, but man, was it effective. First, they built this incredibly complex maze of shell companies to hide who really owned the money. Then they took that dirty cash and plowed it into things you can see and touch, luxury real estate, fancy cars, you name it, to make it look legitimate. And the whole time, they were funneling funds through tons of different bank accounts, just making it a nightmare to trace the money back to its source. All right, Section 2, how the system failed. And this is the big question, right? In a place like Singapore, known for being super strict with its rules, how on earth does something this massive even happen? Where did things go so wrong? You know, it wasn't just one single point of failure. It was more like a perfect storm. First off, the verification of where all this money was coming from, totally inadequate. Then you have the basic know your customer stuff, the customer due diligence. It just wasn't up to snuff. The criminals hid behind those shell companies, making it almost impossible to see who the real beneficial owners were. And get this, even when clients were flagged as high risk, the ongoing monitoring was just weak. It's like the whole system was just checking boxes instead of looking at the very real risk right in front of them. So, with its reputation on the line, the Monetary Authority of Singapore had to do something. And they didn't just respond, they came back with overwhelming force. This wasn't about patching a few holes. This was about rebuilding the entire fortress. And you have to understand this wasn't just a one-and-done fix. No way. We're talking about a multi-year campaign to fundamentally tighten the screws across the entire financial industry. The second this thing broke in 2023, supervision went through the roof, and they've been rolling out tougher guidance and enforcement actions that are going to last for years. This is a long-term overhaul. And their response was incredibly targeted, almost surgical, really. They marched right into the major banks for on-site inspections. They slapped huge financial penalties on firms that weren't playing by the rules. But here's where it gets interesting. They zoomed in on the weak spots, demanding way tougher due diligence on wealthy clients. And this is the real game changer. They started holding senior management personally accountable for failures in the company's risk culture. Okay, let's zoom out. Why should you, no matter where you are in the world, care about this case in Singapore? Because this isn't just some local story. These are major lessons for the entire world of global finance. Lesson number 1, and this is a big one, the post-scandal surge. You can pretty much set your watch to it. Whenever a huge laundering event like this happens, regulators are always going to come back with a structural tightening of the rules. It's a predictable pattern, and compliance teams everywhere need to be ready for it. Next up, the spotlight is now squarely on wealth management. I mean, think about it. Massive sums of money, really complex financial products. It's like a magnet for criminals. This case put that entire sector under a global microscope, and now it's seen as a major potential vulnerability. And here's another huge shift: governance accountability. You know, it used to be you could maybe blame a faulty process or some junior staffer. Not anymore. Regulators are looking right at the C-suite, at the board members. The message is loud and clear. The buck stops at the top, period. And finally, let's talk about verifying the source of a client's wealth. The game has completely changed here. It is not enough to just collect some documents and check a box. No. Now, your verification has to be credible, it has to be risk-sensitive, and it has to be solid enough to survive intense regulatory scrutiny. So, when you put all of this together, what are we really talking about? It's a fundamental shift in mindset. We're moving away from that old reactive culture, just checking boxes, doing the bare minimum, to a truly proactive culture, one that actually assesses real risk, anticipates threats, and builds defenses that are way stronger than just the rulebook. So let's boil this all down. What are the ultimate takeaways you need to walk away with? First, high net worth clients are, by definition, high risk. You've got to treat them that way. Second, the hit to your reputation from something like this, it can hurt way, way more than any fine. Third, effective, ongoing monitoring isn't just a good idea, it's absolutely non-negotiable. And finally, never forget this. A scandal of this size changes the rules of the game for everyone, for years to come. The goalposts have permanently moved. There's an academic summary of this that just hits the nail on the head. It perfectly captures the core lesson here. Massive failures force massive, long-lasting change. The Singapore case was basically a signal flare, telling the whole world that scandals trigger reform. And the focus now is all about governance and bulletproof wealth verification. And that leaves us with one final, pretty sobering thought. As the bad guys get smarter and their methods get more complex, this whole story is a stark reminder. It proves that any financial hub, no matter how trusted it seems, could be the next one in the headlines. The only question is, who will be ready for their wake-up call?